Welcome! I'm glad you're here because today we're going to talk about something that can truly change your life: how to invest your money wisely and confidently. Today, we're tackling a big question. How should you invest your hard-earned savings? It's a question that almost everyone faces at some point, and the answer isn't always simple. You've worked, saved, and now you want your money to grow for your future. Whether you're saving for retirement, a home, or your children's education, making your money work for you is essential. But investing can feel intimidating. What if you invest at the wrong time? What if you make a mistake and lose your savings? These worries are completely normal. What if the market crashes? The fear of losing money can be paralyzing, especially when headlines are full of doom and gloom. Many people let fear keep their money in low-yield savings, missing out on growth. Over time, inflation can eat away at your savings if you don't invest. The key is to have a plan. A solid investment plan helps you stay focused and avoid emotional decisions when markets get rocky. There are two main strategies: dollar cost averaging and lump sum investing. Each offers a different approach to putting your money to work. Each has its pros and cons, and the right choice depends on your situation and comfort level. It's important to understand both before making a decision. The best strategy is the one that lets you sleep at night. Peace of mind is just as important as potential returns. Today, we'll break down both approaches, using simple examples and clear explanations so you can see how they work in real life. My goal is to give you the knowledge and confidence to make a smart decision that fits your goals and lifestyle. You have the power to shape your financial future. Every step you take today can have a big impact tomorrow. Let's get started and get smart about investing. The journey to financial freedom begins with understanding your options. First, what exactly is dollar cost averaging? We'll explore how this method can help you invest steadily over time. Then we'll look at lump sum investing, putting all your money to work at once and what that means for your returns. We'll compare them side by side so you can see the differences and decide which fits your personality and goals. By the end, you'll know which approach fits you best and you'll feel ready to take action. Investing doesn't have to be scary. With the right tools and mindset, you can build wealth and security for yourself and your family. With the right information, you can take control. So grab your notebook, jot down your questions, and get ready to learn. Let's dive in and demystify your investment options together. You're about to take a big step toward financial empowerment. You owe it to yourself and your loved ones to make smart choices. Ready? Let's begin. Scene 2 is next. Let's break down dollar cost averaging, or DCA. This is a popular investment strategy that's simple to understand and easy to put into practice, no matter your experience level. DCA means investing a fixed amount at regular intervals, regardless of whether the market is up, down, or somewhere in between. You set a schedule, maybe monthly or bi-weekly, and stick to it no matter what's happening in the news. You're not trying to time the market or guess the best moment to buy. Instead, you're just consistent, letting your routine do the heavy lifting. Think of it like paying a bill. Every month you invest the same amount, making it a habit that fits right into your budget. For example, you might decide to invest $500 each month into an index fund, no matter what the market is doing. If the share price is $50, your $500 buys you 10 shares that month. If the price drops to $40, your $500 stretches further, buying 12.5 shares instead. If the price rises to $60, you'll get about 8.3 shares for the same amount. Over time, you'll collect shares at a variety of prices. When prices are low, you buy more shares. When prices are high, you buy fewer. This helps you avoid buying all your shares at a peak. Over time, this approach smooths out the average price you pay per share, reducing the impact of short-term market swings. DCA takes emotion out of investing. You don't have to worry about making the perfect move or reacting to every headline. You don't panic when the market drops. In fact, you're actually getting more shares for your money during those dips, which can pay off in the long run. It's a disciplined, steady way to build wealth, helping you grow your portfolio over time without second-guessing yourself. You avoid the stress of trying to predict market highs and lows, and you can tune out the noise of daily market news. DCA is about consistency, not perfection. Like any good habit, it's the regular practice that matters most. It's a great way for new investors to get started, since you don't need a lot of money or experience to begin. You don't need to be a market expert or spend hours analyzing stocks. Just follow your plan. Just stick to your plan and let time do the work. The longer you stay invested, the more you benefit from compounding and market growth. DCA helps you invest through all market conditions, bull markets, bear markets, and everything in between. It's a powerful tool for long-term growth, helping your investments flourish steadily over the years. Now, let's look at lump sum investing and see how it compares to DCA. Now, let's talk about lump sum investing. This means investing a large amount all at once instead of spreading it out. For example, if you receive a $60,000 inheritance, you invest it all in the market on a single day. Using our index fund example, if the share price is $50, you buy 1,200 shares immediately. Your money is fully invested from day one. If the market rises, your entire investment benefits right away. If it falls, you feel the full impact. Lump sum investing is bold. It requires conviction and a strong stomach for market swings. The main idea? The sooner your money is in the market, the more time it has to grow. Every day your cash sits idle, it misses potential gains. Lump sum investing is about maximizing time in the market. It's not for everyone, but it can lead to bigger rewards. However, it comes with psychological challenges. You need to be prepared for volatility. Let's compare the strengths and weaknesses of each approach. Let's weigh the pros and cons of dollar cost averaging. DCA's biggest strength: it manages your emotions. By investing gradually, you avoid the fear of a sudden market drop. It removes the pressure of trying to time the market. No one can predict it perfectly. DCA enforces discipline and consistency. The downside? Cash drag. Some of your money sits idle, missing out on potential gains if the market rises. In a rising market, DCA usually underperforms lump sum investing. But for many, the peace of mind is worth it. DCA helps you start investing and stick with it. It's ideal for new investors or anyone nervous about market swings. The trade-off? You may give up some returns for lower stress. But staying invested is what matters most. Now let's see the power and peril of lump sum investing. Lump sum investing often wins on paper. Historically, investing all at once outperforms DCA about 2/3 of the time. The reason? The market trends upward over the long term. More time in the market means more growth, but the risk is psychological. If you invest a lump sum and the market drops right after, it can be gut-wrenching. Many panic and sell at a loss, derailing their goals. Lump sum investing requires emotional resilience. You must be able to handle volatility and stay the course. The math favors lump sum, but emotions can sabotage your success. Know yourself before choosing this path. If you can't stomach big swings, DCA may be safer. Let's see how this plays out with Maria and David. Meet Maria and David. They're both smart, thoughtful investors who have just come into a windfall. Each has inherited $12,000 and is eager to make the most of it. But while their starting point is the same, their approaches to investing couldn't be more different. Both decide to put their $12,000 into the same index fund, hoping to grow their wealth over the next year. But they each choose a different strategy to get there. David invests his $12,000 all at once. This is called a lump sum investment. He's confident the market will rise and wants his money working for him right away. He buys 120 shares at $100 each and lets it ride, trusting in the long-term growth of the market. Maria, on the other hand, prefers to play it safe. She chooses dollar cost averaging, or DCA, investing $1,000 each month for a year, regardless of market ups and downs. As prices fluctuate, she buys more shares when prices are low and fewer when prices are high. This helps her avoid the risk of investing everything at a market peak. By year's end, the market rises to $120 per share, rewarding those who invested early. David's 120 shares are now worth $14,400, a great return for his lump sum approach. Maria's average cost per share is lower than the final price, but because she invested gradually, some of her money sat in cash while the market was rising, so her total return is a bit less. In this rising market, David's lump sum approach comes out ahead, showing the power of investing early when markets are climbing. But if the market had crashed after their investments, Maria's DCA strategy would have cushioned her losses, letting her buy more shares at lower prices and reducing her risk. The outcome really depends on which way the market moves after you invest. Timing and market direction play a huge role. Lump sum investing wins in rising markets, while DCA offers protection in downturns. Both strategies have their own strengths and weaknesses. The right choice for you depends on your risk tolerance, your comfort with market swings, and your investment timeline. So, When is DCA the best move? Let's find out together. When is dollar cost averaging the right choice? First, if you don't have a lump sum, most people invest from their paychecks, like in a 401k. Second, if you're new or nervous about investing, DCA helps you ease in and build confidence. Third, if you think the market is overvalued or volatile, DCA can protect you from investing everything at a peak. DCA is also great for those who value discipline and want to avoid emotional mistakes. It automates your investing, keeping you consistent. If you're prone to second-guessing or reacting to headlines, DCA is your friend. It's a guardrail for your financial journey. DCA is about building wealth steadily, with less stress. It's not always the highest return strategy, but it's often the most sustainable. Choose DCA if you want peace of mind and a system you can stick with. Now, when should you go all in with lump sum investing? Lump sum investing shines when you have a long time horizon, 10, 20, or 30 years. If you receive a large sum you won't need soon, history says invest it all as soon as possible. This approach is for those with strong nerves and belief in long-term growth. Lump sum also makes sense after a big market drop. You're buying at a discount. If the money isn't life-changing, the risk feels smaller, and the potential upside is greater. Lump sum investing is about maximizing growth by giving your money the most time in the market. But you must be able to handle short-term losses without panic. If you're emotionally resilient, lump sum can be powerful. If not, DCA may be safer. The best strategy is the one you can stick with. Let's wrap up with how to make the right choice for you. So, which strategy is best? There's no universal answer. The right choice is the one you'll stick with for the long haul. If you value peace of mind, or if market drops make you anxious, DCA is for you. If you have a long time horizon and can handle volatility, lump sum investing can maximize your returns. You can even combine both, invest half now, DCA the rest. The most important thing is to start investing and stay invested. Don't let indecision keep you on the sidelines. Choose a plan, write it down, and commit to it. That's how you take control of your financial future. Remember, consistency beats perfection. Your best investment is the one you can stick with. Take action and let your money work for you. Thanks for watching. Now go invest with confidence.